All right, so the big news in the Canadian real estate market this week is we just saw the Bank of Canada increase the rate for the seventh time this year. So I brought on my mortgage specialists, Mark and Eric from the Ottawa Mortgage Shop. Thanks for coming by, guys.
Thanks for having us.
Yeah, thanks for having us again.
And I guess I want to ask a couple questions that is on everyone's mind. So first off, what happened this week?
So rate hike of 0.50%. They were debating on 0.25 and 0.50. So they decided to make it 0.50, showing maybe a little indication of slowing down going forward. There will be another announcement in January, but from what we could see, I think this is the end of the road when it comes down to rate hikes, and we should be seeing something closer to the summer of a slight decrease as we move forward to through the times.
Okay, and so what does this really mean for maybe a home buyer looking to get into the market?
The biggest thing right now is it means obviously a higher mortgage payment with a higher interest rate. It also means that the qualifying rate has gone up. And that's the one that's really important to keep in mind when people are trying to buy a house, because you're not qualifying, as we've talked about before. You know, the 5-year fixed rate right now on an insured mortgage, so less than 20% down, we can get at about 4.94, 4.89, depends, but around there. But you have to qualify for your mortgage at that plus 2%. So every time the Bank of Canada increases these rates, well, that qualifying rate goes up. So right now, for example, we're going to use 494 today for any numbers or whatnot, but you're actually qualifying at 694. So okay. That's one of the big things it means. It means that the economy is also still, I guess, a little bit overheated. They're still trying to calm it down, and that's why they're putting these pressures on the interest rates.
Okay, so we're talking about the qualifying rate as percentages, but what does that mean for maybe someone with a different income or a different purchase price?
Yeah, I mean, if you don't mind here, I do have some numbers that I can just go over quickly. So we're just, as I said, we're going to use 494 again. So I put down 3 scenarios because we had talked about maybe talking about this. So $350,000 mortgage, a $500,000 mortgage, and a $700,000 mortgage. So right now, let's just go right in the middle to 500. Your mortgage payment's about $24.38 monthly. And to be able to qualify for that, you'd need a total household income with no debts. Okay, so you have to be debt-free, no cars, no lines of credits or anything like that, of approximately $110,000 a year. So if it was just at the 494, then probably, I don't have the exact figures here, but probably maybe an $85,000 income would do it as opposed to 110.
That's significant.
It is, yeah.
Yeah, gone are the days that single income 80,000. Getting approved for a house of the market that we're in right now. So we're seeing a lot of co-signers coming into play. Either it's a parent or a family member to come and help qualify for the mortgage, but still keeping the payments to a reasonable amount. When you're looking at $2,400 for a $500,000 mortgage, when a lot of people are renting out there. You're renting a townhome and you're probably paying the exact same amount for a rental property. So
yeah,
because the prices of rents are going up as
for sure. And I just learned that right now. Like, I'm surprised by those numbers. So
yeah.
Even so, I mean, as the market comes down, the houses get more affordable. It's not that even someone's going to qualify to actually buy this home.
Yeah, so they're not. I guess the rates are going up a bit higher than the houses are going down, if that makes sense. But so it's still tough, especially as Eric touched on, single income household is very difficult. You need a really good income. And the fact of the matter is that most people do have a little bit of debt, whether that be a car payment or a line of credit. So these numbers that I'm giving you are very, for somebody who's very, very clean as far as debt's concerned. So for normal people who are carrying a $500 car payment or, a couple credit cards, that those numbers increase even more.
And we've, even though we saw an increase in the Bank of Canada rate and the prime rate did go up, we've seen a slight decrease in the fixed rate. So the fixed rate used to be about 5.20, and now you're able to get 4.89, 4.94. So it's stabilizing a little bit on the fixed side. So there's some positives out there that we're seeing in the market, but the Bank of Canada had no choice but to up it a little bit more to settle down the inflation, to try and, short-term pain, long-term gain, to try and have, this market or this economy, move up a lot or grow higher a lot faster.
Mm-hmm.
And one of the good things is, those numbers that I discussed, those are insured mortgages. So when you qualify through the traditional way of having a TDS, a total debt servicing ratio of less than 44% down. Now, there's a lot of other lenders out there, alternative lenders, some people call them, or B lenders, that will, soften those numbers a little bit, where as opposed to a 44% TDS, they might go up to as high as 60 or 50, depends on the case. So people are still able to purchase homes right now when they're cheap. Sure, these comes with a bit of a premium. However, if you're getting the house cheaper, it's a short-term fix when you're in these things. And hopefully in a year from now, for example, things have stabilized. Prices of houses might have gone up again. So you got in cheaper and there's still solutions. There's private mortgages, there's all sorts of stuff.
Yeah, I know. I love when you guys come on because that's something that is the hardest thing for most people to understand, right? Is that they're waiting for the home prices to come down, but they're actually having a harder time purchasing the homes with the rates.
And with these B lenders, I mean, they have certain niches that they work with, whether it's a high debt ratio or bruised credit or anything in that aspect. But the interest rate's not that much of a difference. You're looking at probably 0.50 difference than what you would get on a normal fixed. And usually it's a 1 or 2 year term that you take with these B lenders, giving you that opportunity in 2 years when the rates have gone back down to be able to benefit from the new rates that are coming out as well. So it's a good little tool to have. A lot of people have always, when you say B lending and all that type of stuff,
They stick to it.
Yeah, they sort of, they don't like that word because of what it used to be in the past. Now, it's a lot more common. The rates are not that much of a difference between, your normal banks, and you're able to get in the market right now when, home prices are lower.
Do you guys know off the top of your heads, like best guess, what a mortgage payment on say 500K would be difference between A and B right now?
You're probably around $150.
What kind of mortgage are we talking about? Like
let's say the 500,000.
Yeah, maybe a little bit more than that, but around there, that seems fair enough. Yeah. The one caveat though that we have to say when it comes to these B lenders is that they can't be insured, the mortgages, which means that your down payment has to be at least 20% down.
Yep.
And that can be gifted from parents, the bank of mom and dad or whatever the case is. But that's the one thing that's a little bit more difficult, if you will.
Yeah. So I guess, is there any advice that you'd have for someone who is, looking at the market or not quite on the range of getting qualified the way things are, on how to improve maybe their chances in the coming future as the real estate opportunities start presenting themselves?
Down payment is one for sure. If you're going to increase your down payment, you're increasing your purchase power. So saving up for that down payment would be the number one. And number two, if you do have that opportunity to get a cosigner or have a cosigner in mind, have that discussion and see if this is something that you can do. And a lot of times with the cosigners, once the rates start going back down, the qualifying rate goes back down, and then you're probably going to qualify by yourself for this house, we could take that cosigner out. It's called a mortgage assumption. So you assume the mortgage, and it's a short-term relief in order for you to get into the market. I think that's another key. And
the other thing I'd say is don't be scared to get turned down. So talk to a mortgage professional like Eric or myself, and we can tell you how close, how realistic your goal is. And on top of that, we can get a pre-approval done. And most pre-approvals are good for 120 days, so 4 months. And that locks in not just the rate, but also importantly locks in the qualifying rate. So if the Bank of Canada, for example, was to increase again by a quarter point or half a point in January, and you got a pre-approval done through us or another mortgage professional now, well, that's not going to impact your purchasing power. So keep up to date, and we're here to give advice. And there's no, people are frustrated, or even, sometimes maybe in a certain way ashamed of not qualifying for a mortgage. It's a very normal thing right now, and let us help you, I guess.
Yeah. And then I guess, what about when we're looking at qualifying for a mortgage, or once you have the mortgage, the fixed versus variable, or even people today who are on mortgages and seeing their payments go up?
It's a question that every single client has. Should I go fixed? Should I go variable? And to be honest, and we've talked about this in the past, where we strategize with variable if you want to maybe refinance in a bit once the prices go back up, and then get the cheaper rate. But it all depends on people's risk appetite too. There's some people that they know this is their budget; it can't be stretched more if the rates do increase. So those people there will tend to put towards fixed.
Yeah, and what we suggest to our clients too is, look at a shorter term. We're so used to seeing, 5-year fixed coming out of everybody's mouth when they purchase, because that used to be the norm. Now we have more discussions about a 2-year fixed. So you go into the 2-year fixed, and then in 2 years from now, the market has gone down, and you can benefit from, the lower rates, or a variable term, which not everybody has the stomach for it, but a variable term, as soon as the rates start going back down, you're going to benefit from it right away, right? So for the people that have mortgages right now, I would look at a shorter term or a variable term. If you're not comfortable with the payments, you have equity inside the house that you could take out money and put it aside if need be, or put it on a longer term. So if you have 20 years remaining on your mortgage, maybe you put it back to 25 years. Maybe you put it back to 30 years to be comfortable with those payments. And after your 2-year fixed, or whatever you decide term-wise, you could take that 25 and you can bring it back to 18. You could bring it back to 17, all depending on how comfortable,
long-term goals,
how
right?
comfortable you are with the payments. I think that's the main one. And luckily, in Ottawa and Canada, we have a lot of people that have equity in the home. So when it comes down to being able to renew and being comfortable with the payments, we have that flexibility of being able to move the amortization to keep the payments similar than what you have now.
Yeah, I think that should be touched on too, right? Because even though we have seen prices come down, and people who bought recently are seeing their values go down, most people still have a lot of equity in the home. Do you guys know what we're looking at in delinquency payments and possible foreclosures or defaults?
So the last report comes, I think we're still a little early on that, since people are still in their terms. I think we might have a better discussion, next year, closer to the summertime, to see, how the market reacted.
That's it. It takes a while for all this to actually, and the Bank of Canada keeps saying it, we're not necessarily going to feel the impacts right now of everything that's happening. It's kind of a year down the road type of thing.
Yeah, and we're lucky in Canada that we have, mortgage insurers that are there, and in the past 2 years, a lot of equity has come in the homes where you do have that flexibility. So I don't foresee it being since we started over 15 years, we haven't seen much of the foreclosures and default rates climb up that much. So.
Yeah, and I think that's where the qualifying rate plays a huge factor into it, right?
Exactly.
As much as it's making it hard for people to qualify,
that's the purpose of it, right?
That's what it's there for. Yeah.
All right, I think that sums up most of the questions that I have. Is there anything else that you guys would like to share to anyone who's interested in what's going on in the mortgage world today?
When it comes down to renewing, I think the biggest thing is don't just sign on a dotted line when it comes down to your bank sending you a renewal. Do your homework, do your shopping. Money matters, and a difference of rate of 0.10 or 0.15 can save you hundreds of dollars. So do your research. Talk to a broker. Brokers have 40 different lenders that they work with, so they're able to find you that best deal, and have the discussion. If you're tight on certain aspects, if you have debt, we can consolidate that debt and limit that stress and
improve your cash flow.
So just ask the questions and look at your options before you make any decision.
Thanks again for coming, guys.
Yeah, thanks for
Thank you. Thanks for having us.
And if you guys have any questions, please put it in the comments below. We'll make sure to get them answered for you in the future.